In today's episode, we're going to talk about GameStop, and I'm going to explain everything that's been going on with this company from 2020 until today. Now, that's a lot to cover, but we're going to get into it right here. Now, we've got to talk about, first of all, Roaring Kitty re-emerging on social media after a 3-year hiatus, and he comes back posting memes. But some of these memes are deeply symbolic. You need to sort of translate and decipher the code, but there is meaning in them, which I'm going to try to help you understand. We're also going to talk about his recent live broadcast, which I know many of you, including myself, were super hyped up, like, all right, he's going to tell us the thesis and give us the story, and this stock is going to go to the moon. There were 600,000 people tuning in live for that broadcast. And I think a lot of us were let down. We were like, wait a second, he's late, he's unprepared. But I'm going to throw a theory out there here. I've been thinking about this. He's a really smart guy. What if that whole live broadcast was presented exactly how he intended it? So then what is the purpose of coming across as dumb money? Maybe to trap short sellers? Well, we're going to get into that in today's episode. But one of the things that he said during that live stream was that his thesis on GameStop is more or less the same as it was when he took his first position back in 2020. So now what I want to do is take a look back to 2020 and look at his thesis. So I went back and I rewatched some of those videos. He's got a 3-point thesis that he laid out very clearly in 2020. And I want to see how well that applies to GameStop today. We're going to dig into the fundamentals. We're going to look at the gross margin. We're going to look at the revenue. We're going to look at the market cap, and we're going to try to figure out whether or not GameStop today represents the same opportunity for a short squeeze that it did back in 2020 and 2021. Now, you may have seen me over the weekend on the news, national news, bringing my pasta shirt to mainstream media when they were interviewing me and asking me about my opinions on GameStop. So if you're wondering whether or not I'm qualified to speak on this, well, News Nation thinks that I'm an expert on day trading. I was flattered. So, of course, I didn't expect that they would be interested in having me with my colorful pasta shirt. Today, I've got my cactus on, but I am a day trader. I've been doing this for a long time, and I traded GameStop back in 2021. I've traded it again here in this recent surge. So I'm very familiar with the way the company trades, the way the stock trades. And of course, I've been following Roaring Kitty through this whole thing. So let's talk first about Roaring Kitty's 2020-2021 thesis. So what he presented in really articulate videos, which really exemplified his skill as a securities analyst, was that the risk related to digitalization is overblown, first and foremost. And what that means is that in 2020, everyone was saying GameStop is an old-fashioned brick-and-mortar business. They're going to be bankrupt. They're not going to evolve. They're not going to be able to adapt to the digitalization. Look, gaming consoles are switching to digital downloads, right? People aren't going to be buying discs anymore. And he argued that the risk related to digitalization was overblown, that in fact, there was still strong demand for physical games. And the transition to digital has been slower than expected. And part of that was because some of the new consoles had limited memory, and some of these new games were so huge, you really still needed to buy a disc. So physical discs at that time in 2020 represented a significant portion of sales for the company. Now, this is 4 years ago, but we're going to compare that to today. Second, he said sentiment is overly bearish. People just saying, reiterating, brick and mortar is dead. Nobody shops there. Digital's the future. People are buying their consoles, their PlayStations and Xboxes. They're buying them on Amazon. They're not going to go into a GameStop to buy it. Well, those are fair points. People saying I'm downloading everything. And he said bearish investors assume that all others think like they do. So they have a hard time recognizing that there are actually people who do want a physical copy and who do still go into the store and are still trading in old games. And so he said in 2020, when the price of GameStop was about $4 a share, that they're pricing it as the market is pricing it as if bankruptcy is imminent and this company is going to be obsolete. So and that was reflected by the fact that the short interest in 2020 going into 2021 was over 100%. So these big hedge funds, they were burying GameStop. And of course, we now believe that there was a lot of naked short selling involved, which allowed the market to just pummel sell order after sell order after sell order and beat GameStop to the ground. But he presented a thesis and a theory that perhaps this is not so accurate. Perhaps value is being overlooked. And he said GameStop is the epitome of value investing. Negative sentiment is out of balance with book value, and fundamental improvements have been occurring in the previous 12 months of 2019 through 2020. He said there's new management, there's a new board of directors, expected increase during the launch of the new console. So fall of 2020, we were getting the launch of new gaming consoles, which would boost cash flow. And so he presented the idea that what if from the cash flow generated during the launch of this new gaming console cycle, they're able to take that cash flow and transform and reinvent the company to gain a larger foothold in this digital gaming space. That could perhaps be a turning point. Now, at the same time, Michael Burry, who's the short seller famous for The Big Short, had taken a 5.3% investment in GameStop in 2019 and began writing letters stating all the reasons that they could turn things around and what they could do. Then Ryan Cohen, he was the founder and owner, CEO of Chewy.com. He acquired a 12.9% stake between August and December of 2020. So now you've got sort of this, the 3-point thesis of risk-related digitalization is overblown, sentiment is overly bearish, and value is being overlooked. And he said in a follow-up video that he's betting on just 3 things when it comes to GameStop. He's betting on the equity of the company being worth more than $250 million. He estimated that the book value was approximately $435 million at that time in July of 2020. So he felt that by buying a company below book value, he had a good margin of safety. Now, the only reason a company would trade below its book value, I mean, let's think about this for a second. If let's just say you're thinking about buying a company and they have all this inventory, they have all these assets, they have all this actual value, and that is more than the purchase price of the company. Some people will buy the company and just strip it for parts and resell it. But some people will say, oh, well, some of the things they're pricing in as part of their valuation, maybe it's a little, I don't know, what would Trump say? The price is a little too high, right? So maybe they're being a little too friendly with their valuation of some of these assets. And so there are times where companies facing bankruptcy will trade well below book value because there's a concern that they've inflated some of the values on some of the assets that are on the balance sheet. But nonetheless, buying below book value is always a great idea for a value investor. Now, when we talk about value investors, we're often talking about people like Bill Graham. We're talking about Peter Lynch. We're talking about Warren Buffett. These are long-term value investors. So in July of 2020, the current price was about $4 a share, and they had a market cap of $250 million, and they had $6 billion of revenue, which meant GameStop was trading at just 4% of revenue. So 4% of revenue right here. This was in 2020. All right, so now we'll compare 2024 in a second. So in 2020, they were trading 4% of revenue. So then they were also had short interest in excess of 100%. So short interest here. And this was price to revenue. All right. So he then says, so number one, he's betting that the equity is worth more than $250 million. Number two, he's betting that the legacy business value is actually worth between $500 million and $1.5 billion. That's the value of physical sales and the current business model that GameStop was running. And he established that value by looking at the free cash flow, because the company had historically produced good cash flow, right? Now, it was waning towards the end of the last console gaming cycle, but with the new console coming out in the fall of 2020, he projected that that would improve and that they could use those cash flows to reinvest in the company. And that furthermore, with new management and new leadership, they could do a better job than they had done in the past. He also commented on how they had 42 million rewards members, and 15 million of them, individual people, had shopped in the last year at GameStop. And so he said, based on equity being more than $250 million, and the legacy business value he believed being between $500 million and $1.5 billion. He's betting on those two things. And the third is that they have a better than 0% chance of turning things around, because he said the way the market's currently pricing the stock at $4 a share, they're pricing it as if it's going to go bankrupt. It's trading below its book value, right? And so he said, even if there's just a 1% chance of them turning things around, that alone should improve the valuation and improve the stock price. And so he said this new leadership coming on board, right? Of course, seeing Michael Burry being invested and Ryan Cohen being invested, this is giving some confidence that maybe they can turn things around. Being armed with the future cash flow from the new console launching in November of 2020, right? That's going to bring money through the door. They can use that to transform the business. So the third point was the potential to transition the business, maybe to somehow move into digitalization. Obviously Amazon bought Twitch, but maybe there's a way to kind of get a foothold somewhere in the gaming business that is revenue producing. Maybe it's an acquisition, and if they have some cash flow, they could do that. So again, it's just these are maybes. And if even just one or two of them might work out a little bit, that was enough for him to think that he could get, potentially the stock to go from $4 to $8 to $12, a two-bagger. That's if you double, right? A 2x, 2x, 3x, 4x, 5x, maybe. Now, as we know, was his thesis right? So, of course, that's the big question. Well, it's not really a question. We know what happened. But even today, the price is up 20 times his initial entry. Okay, so when he bought it, it was trading at $4 a share. Okay, so $4 a share in 2020 when he first bought it. So this was the price, which was incredible. What a discount. And as we know, it went up to over nearly $500 a share, but then of course came back down. Now, one of the things that you'll note here on this chart is this S right here. This refers to a stock split. So they actually did a stock split. And when they did a stock split, it was a 1-to-4 stock split. So that increased the float times 4, and it decreased the price by a multiple of 4. And so the current trading price of $20 adjusted for the split would actually be $80 a share. And I think some people don't understand that. They're like, oh, it's back to $20. It's like, no, well, it's actually holding $80 if not for, the reverse split, the way it affects the numbers. But let's look at how his thesis played out point by point. All right. And then we're going to see whether or not we can apply it today. So on each of his three main points, equity. Today, the equity is $1.3 billion. That's 5x. Now, remember, he bought it when the price was trading below book value. It was a steep discount. That's great value investing. The legacy business value. Well, as I'll show you, and as we know from the breaking news of earnings that came out, a surprise early release of earnings, GameStop's gross revenue was down, I think it was 29% in the first quarter of this year versus Q1 of last year. 29%, that's a steep decline. So the legacy business value is continuing to decline. And the potential transition of the business, well, I think that's still, at least as far as I can tell, to be determined. They've done some things. They launched an NFT marketplace, but those are kind of going out of popularity. I think they were a little late to the game on that. But let's talk about the biggest contributors to equity growth, because no doubt the stock is still up 20x what he initially got in at. So the biggest contributor to this huge return, I would say, was the short squeeze. Without the 100% short interest in 2021, we would not have seen the squeeze to 500. It just wouldn't have happened. Now, that made GameStop as a stock a household name. Even if GameStop as a company, people were kind of forgotten about it, it made the stock a household name because, of course, Roaring Kitty, he became a legend. I mean, this guy takes a $40,000 account and turns it into $40 million. And of course, it was unrealized. I guess we don't know exactly how much he locked up, but that's the stuff dreams are made of. That's absolutely incredible. So he really spoke, he stood for the little guy, for the little fish who usually gets swallowed and spit out by the whales and the sharks out there. And so his success was like all of our success. And I'm the little guy too. I mean, I make some money trading, but let's be real. I'm not a hedge fund. I'm not the big banks. I'm not the big money. So for us, seeing that success was huge, but that ignited this cultural movement to buy GameStop and stick it to the man, right? I think that's what people were doing. It was like, let's see those short squeeze, let's see the shorts get squeezed. Let's see those hedge funds, burn. And so if it weren't for that, the stock wouldn't have gone up to 500, right? The fact that it became a cultural phenomenon, it no doubt amplified its current market value. But then the company conducted a series of secondary offerings. And so the company took advantage of the inflated prices and sold shares onto the market to raise capital. So they essentially converted shares to money. And that boosted their assets because now they have $1 billion of cash sitting on the balance sheet. And no doubt it was retail buyers who were supporting the price during these offerings. So, there's a little bit of the company has a fiduciary obligation to its shareholders. A lot of retail traders are the shareholders, but also it was selling shares to more shareholders to raise money. So the biggest contributors to the equity growth, I would say, was the short squeeze and the secondary offerings and the price being propped up by retail traders. So when it comes to the legacy business value and the possible transition of the business, those, well, to a lesser extent, I don't think, as far as I can tell, that I've seen the meaningful improvement in this area. I mean, just looking at the fundamentals, which we'll look at in a moment, I don't see it. The potential of the transition in the business to better capitalize on digitalization, haven't really seen that either. It's now been 4 years, right? We've had a new board of directors. We've got new management. Ryan Cohen became the CEO in September 2023. So he hasn't been the CEO for very long, but I don't think we've seen the degree of change that maybe I would like to see, and probably many people would like to see. So from his initial entry at $4, the stock price, to remove the 4-to-1 stock split, has remained between $80 to $100 a share, which is phenomenal, right? So 20x his current price. So the time when he bought deep value. That's why his name is Deep Effing Value. He bought deep value at $4. He said, I believe in the company. He's a security analyst. He analyzed the fundamentals. He looked at the balance sheet. He looked at the earnings. He understood the business, and he made a bold call that most people didn't see, and he was 100% right. Well, I wouldn't say 100% right. He was obviously made a ton of money, but and he didn't need to be 100% right to do well, which is okay. Right? He just needed to be right enough. And that's fine. Look, I mean, this is the market. If you're right enough and you make money, that's great. He was right about it being undervalued and shorts being wrong, ultimately. And they got squeezed hard. Okay, but so now let's kind of move forward. So is the 2020 thesis still valid today? Are we going to see a short squeeze this year like what we had in 2021? And I'll tell you that I would love to see that happen, because in 2021, I had the best single day of my entire trading career. I had the best week of my trading career. So, life was good in 2021. I think for a lot of retail traders, I would love to see that again. So let's ask that question. Let's see whether or not it applies. In July of 2020, again, he stated he was betting on 3 things: equity being worth more than $250 million, legacy business value being worth between $500 and $1.5 billion, and the potential transition of the business. Okay, so let's talk about equity right now. Well, today, the current equity is $1.3 billion. It is below the peak of 2012. 2012 is when they peaked in equity. But it is much higher than the 2020 lows. So this is the actual chart here that shows the equity. So you could see in 2017, and this was like 2012 back here, it sort of come down a little bit, and then it started tanking, right? This is when the sentiment was super bearish, and it hit this low right here in January, kind of, or it was the end of 2020, and then 2021, we just, rocket up. But we've softened a bit off that level, which makes sense because the price didn't sustain the levels of 2021. But, $1.3 billion in current equity is not bad. It's still 5x what it was back in 2020. The only question is, well, can it 5x from where it is now? Can this become a company worth 6, 8, with 6 to 8, $10 billion of equity. Well, let's look at debt. So they have done a really good job paying off most of their long-term debts. They have right now an offering for an additional 75 million shares to sell, which will raise between 1.5 and $3 billion, depending on the prices that they sell at, which means they're going to have probably at least $4 billion of cash on hand. That's going to boost their balance sheet for sure. This is thanks to selling into the retail trading volume. So paid off the long-term debts. They've got once this offering is done, probably at least $4 billion, maybe $5 billion of cash on hand. So this is pretty exciting, right? So this is sort of where we're at right now with equity. We've got a lot of cash on hand. That's good for the balance sheet. But how much higher can it go? So today at $20 a share, which is the price that Roaring Kitty bought 120,000 option contracts to control 12 million shares. It's actually trading at 120% of revenue. So this is a little bit of a problem. Remember in 2020, it was trading at 4% of revenue. So the way we got that number was we looked at the market cap, which was 250 million, and then we divided that by the gross revenue at the time, which was like 6.3 billion or something like that, something around there. So now you've got so now you've got a market cap on this of, well, at the current trading price, I want to say it's close to 6 billion. I just have to double check, but I checked it earlier, about 6 billion. And then you've got gross sales of 5.3 billion that's right now for the trailing 12 months. So now you're like 120%. So from this perspective, these are vastly different positions. This is deep value. This is more like momentum trading right here. This is like when we're trading a Tesla or an Nvidia. And we'll sometimes trade those when the PE ratios are really high and it doesn't make any sense, but the price just keeps going higher and it's a momentum play. Is GameStop a momentum play right now? I mean, it was kind of looking like it, especially with Roaring Kitty coming back and everyone jumping in. So it was kind of looking that way, but this is a little bit of a different equation. I don't think we can say in 2024 that this is a deep value investment. Short interest right now is about 20%. Price currently, well, $20, but that's adjusted for the split. So it's really more like 80. So it's still 20x the 2020 levels. So this is where it starts to get a little murky. Like, does this thesis really line up? So let's look at the legacy business value. And really the thing here, and what Roaring Kitty was emphasizing during his stream was, he believes in Ryan Cohen. He believes in his ability to turn things around. So, let's kind of go down that path a little bit. All right, well, when it comes to the legacy business value, Q1 of 2024, sales were 881 million for the period, down 29% from 1.23 billion a year prior. Right now, if they're going to have gross sales of 5 to 6 billion, they're going to need to be doing a lot more than 880 million a quarter, right? 8 times 4, 32, right? You're not 3.2 billion. That's going to be way, way shy of where they've been if it doesn't improve the rest of this year. Declining free cash flow. So free cash flow is basically the profit that a company is producing. And investors want to see companies that are producing a lot of free cash flow. In spite of the new console launch in 2020, the business model didn't produce substantial free cash flow. So this is the free cash flow right here for the last 15 years. And you can see that it bottomed out in 2020. It did come back up, but then it came back down, it came back up, and it came back down. And right now they're still producing a loss. And they've got, of course, declining revenue, declining gross sales. So you've got declining gross sales as well, where we peaked here in 2012 and we've sort of been on this decline. Now, yes, we did bounce back up a little bit in 2022, but now we're starting to move back down towards this area here. If we keep up with this rate, we're going to be down around 3 to 4 by the end of the year. So the problem now is we're not in the middle of a new console launch that's going to give them extra free cash flow from operating the business. So the cash that they now have on the balance sheet, it's not from the company producing cash flow. It's from selling shares. That's what it's from. It's from doing the secondary offerings, which is fine. They've raised money, but it's not from running the business. Now, in July 2020, this is a typo here, 2020. In July 2020, Roaring Kitty said, usually with companies that are deteriorating and falling apart, gross margins are also falling apart. And he said that because he was commenting in 2020 about how the gross margins were good. He was like, they're really good. I'm just going to fix this. So I'll just show you here. So let me jump back on the slideshow. So this was what he was looking at right here in 2020. So these are gross margins, and they're 25%, 26%, 26%, 28, 29, 29, 29, 31, 31, 29, 27, 29. So he's like, they still have the same gross margin. Okay, that was January of 2020. So what have the last few years been? 2021, 2022, 2023, 2024. Well, see, now the gross margin is declining. So that's making me a little bit nervous. I'm looking at this too, and I'm like, okay, if Kitty's in, do I want to be in? How much do I believe in this? And I want to do my own due diligence, which is, it's all just our opinion, and I could be wrong. And he's got a great track record when it comes to GameStop. But as I look at it, I'm just trying to understand what his thesis is. And that was the question that I was asking, essentially, the second he posted that he had a $174 million position. I was like, wait a second. He made $40 million on the stock, buying it at $4. And then, hopefully he took profit. He probably has gotten back in and back out a few times, but now he's back in, loaded up with a $174 million position at 20x his original entry. So what's his thesis? And these options are expiring in like a week and a half. So, by the time some of you guys are watching this, you'll already have known what happened. Now, maybe there's a wild card. Maybe, GameStop is going to put out some crazy good news. But he couldn't know that. And if he did, that's insider trading. So he doesn't know that. So he just is speculating that within the next 2 weeks, it just seems like a really aggressive position. And maybe that's what YOLO is all about. And I don't know. But this is concerning to me that the gross margins have decreased. So when we talk about the potential transition of the business, so what's the state today? Well, Michael Burry sold his position, entire stake, out in Q4 2020. Ryan Cohen got 3 seats on the board in 2021, and he added to his position. And in September 2023, he became the CEO. So he's moving up, and he's taking the reins. So when it comes to transitioning, in the age of digitalization, the used game market of discs is expected to disappear. It's going to be like, nobody goes into record stores really anymore. No one buys CDs and sells used CDs. No one buys and sells used tapes. It's going that direction. Now, it's been slower, but it's going that direction. 4 years ago in 2020, investors were pricing that GameStop was going to be like Blockbuster. They were going to be gone within a year. And they were wrong. But the company's had 4 great years here. Again, great. Cash flow, not so great. But they have been able to adjust their balance sheet, and they've been able to raise capital by selling shares. So they've definitely shored up, the potential. But they haven't seen, at least what I can tell, are significant inroads at capturing more revenue. Gross sales are coming down, the margin's decreasing. They now have 56 million rewards members, which is good versus the 42 million in 2020. But it's the same number that have been active in the last 12 months of 15 million, which is kind of interesting. They started this NFT marketplace, but, I don't know about that. So what are new challenges? Short sellers are betting against this company. They are. We see it in the news still. They're not betting against it in the same way they were before. It's not 100% short interest. And also, for all we know, shorts are being a lot more clever about disguising that they're short, so they don't tip off, this new kind of alarm of high short interest. But short sellers are betting against the company. They're vocal about it. I'm not a short seller. I don't take short positions, so that's not me, but there are people who are in that spot. We haven't seen significant inroads to capture more revenue, which I've already stated. Most Reddit traders who have bought, I think, are already in. So I'm a little concerned that we're kind of running out of retail traders who are going to buy up GameStop. Like, if you're not already in, are you going to get in now? Maybe some people are like, oh, I missed the boat the last time. I'm not going to miss it this time. But then just in this last week, they may have already gotten burned. So I feel like we're maybe running out of retail traders who are going to keep propping it up and keep going back to the well, especially if they keep getting burned. So despite a new console cycle, new leadership, 3+ years later, gross margins have declined, total revenue has declined, and free cash flow has declined. So these are some of these charts. These are just showing the fundamentals, right? So we're declining right here on gross margin. We're declining on, what do we have here? Cash flow, free cash flow. Sorry, this is free cash flow. This is revenue. So we're declining right here on total revenue. And, this is not, it's not a value investment right now. So based on Roaring Kitty's 2021-2020 thesis, based on today's data, the risk of related to digitalization is overblown. I don't know if we can really say that. It's 4 years later and these risks are only increasing. The company needs to transition. Sentiment is overly bearish. I don't think it is right now. It's only 20% short interest as far as we can tell. Value is overlooked. I don't think value is overlooked. It's trading at 20x the price of 2020. There is more than a 0% chance of a successful transition, but again, you're paying 20x the price of 2020. So now some people are saying, well, the short interest, Ross, is actually the highest it's ever been. But the short interest right now is stating 20%. What some people are confusing is that the short volume is a lot higher. Now, the short volume refers to the total number of shares that are sold short on any given day. But short volume is not the same as short interest. These could be short sellers who buy, sell, buy, sell, buy, sell, buy, sell all day long, but are not holding a position short at the end of the day. So this higher level of short volume is probably the result of the price being higher, it perhaps being more easy to borrow than it was in the past. Now, when a stock has 100% short interest, it starts to get hard to borrow more shares because there's not more shares available. But when short interest is lower, then there's a lot of shares that are freely available, so people can easily short. And a lot of day traders are shorting it. They're trading it long and short all day long. So you have more short volume, but I don't think that we have more short interest. So, at this point, let's talk about a possible 2024 thesis. What do they have going for them right now? They've got a really strong cash position. I mean, $4 to $5 billion. So super strong cash position. It's not from free cash flow. It's from secondary offerings. They're converting shares to cash, but they've got a great, strong cash position. Digitalization of gaming. All right, the new console cycle didn't improve the financial performance as gross margins declined and free cash flow are also declining. Revenue was more or less stable in 2022 and 2023, but then down 29% in Q1 of 2024. So despite changes in leaderships, the efforts so far have not been reflected in producing free cash flow growth or improving gross margins or total revenue. Well, what about Ryan Cohen leadership? Because this was sort of the thing that Roaring Kitty kept talking about. I believe in Ryan. I believe in Ryan. He's got $5 billion in cash. If they invested it in fixed income at 8%, they generate $400 million a year. Now, considering the current business model, Q1, I mean, they're actually losing money. This would definitely be an improvement. But here's a theory. What if GameStop becomes the Berkshire Hathaway of our generation? Remember when Warren Buffett bought Berkshire Hathaway, he turned it into an investment company. What if Ryan Cohen did that? What if he took this $5 billion and started investing? Now we know that in 2021, he invested in Bed Bath & Beyond, I think it was. He produced a profit of like $60-70 million in a very short period of time. Could he get into the business of being an activist investor, taking strategic positions, growing some of these companies, or even just actively trading them? What if they buy Bitcoin? That's what Tesla did back in during the pandemic. They bought Bitcoin like $1 billion worth, maybe more, and they got more than 8% on that. What about streaming gaming platforms? Twitch, Amazon owns it now, right? It was sold for about $1 billion, I think in 2014. But could there be, I don't know, could there be something else there? Another gaming platform or something else? Is there a way? I think the question is kind of like, either are they going to still try to be a gaming company, in which case they really need seriously to make inroads at this space. So creating an online, gaming store, that could happen. I mean, Ryan Cohen with Chewy.com, he knows e-commerce. So using technology, could they do that? Maybe they could, but I think the economic moat that the existing companies have in that space is deep. There's a real switching challenge that people are going to have. And I'm concerned that that is going to be a lot harder. To be honest, I actually think that might be harder than converting the company into more of a venture capital or even private equity type of firm. They might, with $5 billion, have more success with that. I think one of the things that that I learned from, where's this book? I learned something really interesting reading this book. Quit by Annie Duke. I read it as it pertains to the power of knowing when to walk away as a day trader, having discipline. But she talked about the story of this company that was trying to create I guess it was a game. I think it was a type of metaverse type of thing. Anyways, they were trying to create this game. They spent they raised money from investors. They spent a lot of money building out this game. They launched it. And within a few weeks of launching, the CEO said, "We're done. It's over." Because what he was able to see very clearly was that based on the numbers of people that were coming in, and based on the churn, the numbers that they were losing, it was mathematically impossible that they would ever get to the number of active users to sustainably run the company. There were not enough people in the world to get through based on the rate of churn that they were experiencing. And so they went into the mode of salvage. And one of the things that they had created during their process of working on this platform was a messaging app just for chatting with employees. They called that Slack, and then they sold it as Slack. So Slack was a afterthought. It was something that was created. It was like, someone who, it's like the person who invented a screwdriver was trying to sell chairs, but then everyone wants to buy the screwdriver. It's like, it just, I don't know if that's the story of the screwdriver, but you know what I'm getting at here. So is it possible, that GameStop can find something else? And it could be a complete shift, which is hard. And they'd, of course, have to get the board of directors to buy into it and shareholders to buy into it as well. But part of me wonders whether or not that might happen. Again, you don't want to just pour good money after bad. At a certain point, you've got to know when to cut your losses and walk away. So when it comes to trading, having predetermined like max loss points of like, if this level crosses, we're done, we're out. But as a business too, having points where it's like, if we've gone to this point and we haven't turned things around, that's the point where we walk away. And you have to establish that kill criteria long before you're facing that moment. Because in the moment, you're always going to tell yourself to keep going. It's the sunk cost fallacy. I've already put this much in, I can't possibly walk away now. And people have pissed away millions, billions of dollars, just continue to chase good money after bad. I would hate to see that happen with GameStop. I don't think it will, but it could, because these things have happened before. So now they're positioned with $5 billion in cash, and this empowers them. But in a sense, the problem here is that now the company valuation is becoming based just on the cash they have on hand. It's becoming less and less, I'm concerned that it's going to be less and less based on the current business model, because it's been a legacy business model. They do still have a lot of inventory, no doubt. This is something that Kitty was talking about back in 2020. They have a lot of inventory. When they show that inventory on the balance sheet, it's showing it at cost. And whenever you trade in a game at GameStop, they give you like basically nothing for it. So they've got all of that marked as at cost, not at what they will sell it for. So even if they sell it for only a little bit more than cost, it's still making a good profit. Like fire sale, if they're just like, we got to get rid of everything. But I feel like they have a huge opportunity with the amount of cash that they have, and through strategic acquisitions of potentially gaming websites or gaming platforms, they could transition to gaming. But like I said, there's some already very well-established players in that space. And I, I think that it's going to be harder. I think it's going to be really hard to break into that. It's just, that's like the way it is. It's so tough when you get behind the ball. It's like, remember when, Blockbuster passed up on the opportunity to buy out Netflix. And then next thing you know, Netflix is gaining steam and nobody's going to do mail in at Blockbuster. Like, it's just not going to happen. And it's so hard to break in. Now, Blockbuster did not have the social media, just like, influence that GameStop has. Like, this is something very unique to GameStop, and it's empowered them to raise, $5 billion essentially, which I know for a lot of retail traders who have lost money feels like, I lost money and the company just raised like a couple $1 billion. Like, who's the loser here? Like, I feel like it's me. And when it comes to the live stream that Roaring Kitty did initially, so this is what I was kind of thinking. So let's transition and talk about that for a second. So I'm going to put this just on the side as sort of my possible thesis for 2024 is that they've got a really strong cash position. Yes, we've got digitalization of gaming. I think there's some potential there. They could do some strategic acquisitions, maybe of gaming companies, and create a gaming platform website. They've got 57 million rewards members that they could harness for a social media kind of website. They could try to compete against Twitch or Steam or some of these other players, but it's going to be hard because those guys all have a big head start. And they've got $5 billion and they don't want to waste it. So maybe in the meantime, they can put that money to work, just earning enough money to like kind of, it's a significant amount of money that they have on hand. So when we got the news that Roaring Kitty was going to do a live stream, I was like, oh my gosh, here we go. All right, right? I'm like, yes, that's exactly what I wanted. Because when he posted that he had a $175 or $74 million position last week, there were a couple of things that I noted. Let's see if I have my all my notes here. I'm not sure if I do. Oh yeah, no, I do. So I noted number one, that his position of 5 million shares really only represents 1.8% of the float. The float now has gotten bigger, 269 million shares before this most recent offering. It's now 315 million. It's going to go even higher. So 5 million share position is only 1.8%. I mean, he's one person, but he's not taking kind of a big enough stake to, like, I feel like by himself, like really prop up the company in a sense. Not that you want one person to do it, but he's not doing it. The options that he bought, interestingly, are in the money, not out of the money. I think if he had bought out of the money calls at like 25, 35, 45, 55, 100, that would have sent a message to everyone on social media that those are the calls they should be buying. Because when I saw he's in the $20 strike calls, I was like, I'm not going to buy those. They're so expensive and they're not a YOLO trade. It's in the money. He didn't offer a thesis when he posted his P&L. He just posted how much he was in. And I was like, well, tell me the thesis. Tell me the story. Give me some context. Help me get bought in. Maybe he didn't want to do that because of regulatory concerns, but at the same time, that's what investors do all the time when they go on, the news and stuff and talk about the positions they're in. So he has every right to do that. And I wish he had. Number 4, I felt like the current price wasn't deep value. Number 5, short interest, only 20%. Number 6, I felt that retail and Reddit traders have kind of already been burned. Not a lot of money left, maybe. And number 7, no government stimulus, no pandemic lockdown. So are we really positioned right now for something crazy to happen? Anyways, regardless of all that, and so that was sort of the scenario. And maybe just to back up one step further, it was on May 12th that he posted this meme right here that things are getting serious. So he comes back from his hiatus, 3 years, he posted that meme. And when he posted that, the stock went bananas. And I did pretty well on it, trading it here, as it went basically from $18 all the way up to $80 a share. All he did was post this meme. I'm not even kidding. And it went that high. Now, he continued to post some memes. May 13th, he posted some more memes. Let's see, this peak here was on, what was the date? So this was on the 14th. So he continued posting some different memes. The meaning behind this first meme, things are getting serious. That's what this meme is saying. Things are getting serious. So then he's got a couple of other memes that he's posting here. You've got, some of them, it's like, it's a little hard to read in exactly what we've got going on here, but we've got these different memes that he's posting. And some of them are funny, some of them are a little like, what was this about? And so this is May 13th, May 13th, May 13th, May 14th, it's just continuing. So he's posting these memes. This is a good one. And then the stock peaks at 80 and then dumps hard. It just sells off. And I was kind of bummed because I was like, really, I was hoping it would hold up. Then it drops even more. On the 17th, we get a filing from GameStop here. Let's see, this was on the 17th right here. They filed a shelf registration to raise 45 million shares, to sell 45 million shares. So they've got a shelf registration there. And then the news came out on the 24th that they complete the at-the-market offering of 45 million shares, raising 933 million. So prior to that, they had about, I think it was 900 million in the bank. And then they did another $900 million offering. So that gave them 1.8 billion. I was just looking at the earnings statement. So if we look at, let's see. So I'm just going to pull this up here. So what are we looking for here? Find cash and cash equivalents. So yeah, so January, so they had 922 million, and then right here they sold 933 million. So now I got $1.8 billion. So when the news came out of the offering on the 17th, the price dropped, right? Price dropped right here on the 17th. And then on the 24th, the news comes out and then the price goes up here on the 28th. And then right here on this day, June 3rd, on the morning, on the night of June 2nd, Roaring Kitty goes on Reddit, and that's when he posts this epic P&L of being in 120,000 contracts with $20 calls and being in stock at $21 a share. It's like, oh my gosh, this is insane. So massive position. And there's so many questions. How did he get that money? Did someone invest for him? And he said that's all his money. So he's been YOLO trading for the last 3 years solo, and he's up 200 million. Crazy. So anyways, so then the price squeezes back up. All right. So we got a couple days where it's sort of slow, and then the price right here squeezes back up as soon as he announces that. But this was really interesting because it went up, and then that same day it comes all the way back down, almost retraced almost completely. And I was really surprised. I didn't expect that at all. So then on Friday or Thursday, he posts on YouTube. He's got a live stream scheduled for Friday at 12 p.m. And the stock starts squeezing up here. And right here, it's at 67. And I'm like, oh my gosh, we're going to 80, right? That's the level I'm looking at on the daily chart. Just technicals speaking here, like this is technical analysis. And I'm thinking $80, that's the level. And if we break over 80, let's look at this daily chart. So we know the all-time high was 500, but remember they did that 4-to-1 split. So it adjusts to show that the all-time high right here is more like 120 something. So $120 a share. So I'm thinking if this thing breaks 80, we're going, what's the next level, right? So I'm looking in here and I'm thinking, well, we've got around 88-ish, over 80, over 88, we're going to 120. And that's what I was starting to get amped up for. I thought that was going to happen. And then GameStop releases earnings early. And that's when they released their earnings that gross revenue was down 29%. And at the same time, they posted a shelf registration to sell an additional 75 million shares. They just sold 45. Now they're selling another 75. And if you recall, they sold 45 million shares between the 17th and the 24th. So it's like 5 days. So now they have this filing that they're going to raise and sell another 75 million shares. And now people are like, they're probably going to be doing it like now, like in the next couple days. And so the price tanks. It drops a ton. And then when Roaring Kitty's stream begins at noontime, It's supposed to begin at noontime, and the price is under VWAP. It looks terrible. And at this point, I'm like, I don't even know what he could possibly say that's going to turn this around. The company just shot him in the foot, basically. I mean, it was like everything was lined up here for a squeeze through 80, 90, 100, potentially. Like I saw that all. I could visualize it all. And then the company throws this wild card of this terrible news, right? The bad earnings and selling more shares. It's like they threw water on the fire and the price dropped. And retail traders, well, I guess we got burned again. And so the price drops here. And then when Roaring Kitty starts his live broadcast, he comes in, very kind of like, he comes in 25 minutes late, 28 minutes late, something like that. The stock halted down several times. And then when he comes in, it halts up. And then it halted like every couple minutes while he was doing the broadcast, which was like 50 minutes long. And my initial reaction was like, dude, like, get with the program. Like, I'm like high stakes here. I'm like ready. I've got my account. I'm like ready to trade. And I'm like waiting for him to say the things I want to hear, right? To give me the thesis, to tell me all the reasons that he likes GameStop. And he didn't do any of that. And so initially I was like, he was unprepared. He was late, disorganized. Like, it's kind of like trolling. Just the whole thing was like trolling. It was like a joke. Like, I don't get it. He's kind of trolling E-Trade a little bit. He was kind of trolling regulators. He's like, oh, what can I say? Oh, I can't say that. Oh, stock's going down. And E-Trade, oh, they're going to kick me off, and I just was like, you're not, you're kind of like acting like Dumb Money, right? The movie, Dumb Money. And then, later that day I was thinking about that and I was like, rewatch some of his older videos and I'm like, he's a smart guy. He's a really smart guy. He's done incredibly well trading. So let me assume, my initial reaction was he was unprepared and this and that. And maybe that was wrong. Let me assume that he's really smart, a lot smarter than me, a lot smarter than most people out there. And that everything he did was intentional. If that was all intentional, what was the plan? Well, maybe the plan was just to show people, he can go on live stream and the stock doesn't go up. Right? He's not controlling everything behind the scenes or whatever. I don't think that, I mean, he I don't know, and the problem now is he went from his account being at $550 million to today's P&L screenshot was around 200 and something million. So the YOLO shot for today is 235 million. He's down 51 million today, which I don't even actually, I don't know how that works, but I guess it's the day's gain. Because he was at 586 million back here, which is insane. And he didn't take any of it off the table. So I'm like, wait, what does he know that we don't know? Now he can't know anything. So it's like, so what is it? Is he trying to trap shorts? Is he trying to trick them at their own game? And people are talking about this sort of the series of memes, the Kentucky, oh gosh, what is it? It's something Kentucky switch. Now I can't remember what they call it. But anyways, it's this kind of bait and switch where you trick your enemy into doing exactly what will be their own downfall. So, did he somehow kind of bait the shorts into just slamming short and now, they're going to get yanked? But the short interest isn't really reflecting that. And and he's gone from up 500 million or in his total account value. I mean, the amount of money he's given back is almost unthinkable. And he posted this meme today on Twitter. Let's see. So he posted the Joker. So let's see. So last night, oh gosh, gotta scroll up. These are a ton of memes. These are all memes. These are all just lots of memes. Okay. So, and maybe, I don't know, maybe that's part of the Dumb Money part too, playing the part, just posting memes and the stock keeps going up. But he posted this Uno card here, the green reverse card. So a lot of people are like, oh, what does that mean? We're gonna have a reverse. We're gonna reverse from, selling off to squeezing back up. Then he posts this from the Joker scene where he's walking out with the money. People were looking at this and it's kind of hard to see here. I don't know if I can zoom into this, but if you zoom in right here, this looks like the number 5 right there. So people are like, oh my God, you guys, it's a number 5. Does that mean there's 5 days till he's going to exercise those options? Are there 5? Wait, what is that? But then someone found the original image and it looks like that's just the cat's fur. So I think we're false alert on that one. But and then it was, you were a billionaire. So, the thing right now though is that there's also this question of his current position, because he owns 120,000 contracts and there's not enough liquidity in this options chain to sell. He would not be able to sell these right now if he wanted to, because there's not enough volume each day. And he doesn't have enough cash in his account to exercise those options and buy 12 million shares. But what we don't know is if he has more money outside his account, which would be insane if he turned 40,000 into like 500 million and he could just buy $240 million of stock here, but maybe he could. And if he can, what it seems like he's betting on, all we can tell at this point, is Ryan Cohen to turn things around, because at this point, that really is what's left. You don't have, it's not a value play at this point. I mean, at least not that, as far as I can tell, it's not deep value. You don't have high short interest. The legacy business model, I mean, it's still producing money, but it's got a lot of gross sales, but the margins they're declining. Free cash flow is right now declining. So like, it's all kind of on Ryan. Is he the man? Is he going to be the Warren Buffett of our generation? I don't know. Right. But that's that's the question. And that's what I'm wondering. And I guess that's what we're kind of all speculating here. And so, because this is such an aggressive call, literally, for June 21st, it's a week and a half away, and it could expire worthless. It's $81 million in value right now. It could expire worthless. It could expire in the money. He could, there's so many questions. The 5 million shares, he could just hold that for forever. But the options is a massive bet with a very short duration. And I feel like GameStop, the company, gave him a big wild card with the earnings and the offering. And they took advantage of the situation. And here's something that's kind of interesting. So GameStop, out of this whole thing, has generated what? Potentially $3 to $5 billion of cash. How much has Roaring Kitty made total? 40 million? Maybe more. We don't know. He's got $200 million account. But the person who has benefited the most from all of this is GameStop, the company, because they've sold so many shares. They've got $5 billion. Now, there's a lot of shareholders of GameStop now. And if they're able to turn it around, if they become the Berkshire Hathaway or something else, like, this could be huge. But, Ryan Cohen's not taking a huge salary. He's not being egregious there at all with paying himself or, all these fancy things. He owns shares, 10%, I think, of the company, maybe a little bit more. Well, but then they've done this offering. Anyways, so he feels like he's as much in it as Roaring Kitty is, but at the same time, the people who have benefited the most from all this is GameStop as a company. They've sold so many shares. So we'll just have to see what they do with it. Roaring Kitty, he went up 200 million back to almost break even, and in the interim, GameStop raised $3 billion. So I don't know. Maybe that's Wall Street winning at its game, and maybe Roaring Kitty and the little guys don't win. I don't know if you can call him a little guy anymore, but if he ends up going to break even or losing on this position, GameStop should give him they should hire him and just give him a token salary, because they owe him so much, such a debt of gratitude, because I don't think the stock would have gone up that much if it weren't for him. Maybe they will. Maybe he'll be on the board of directors. I was wondering that, if he's going to try to get on the board. You could see that happening potentially. Maybe he gets involved. Maybe that's his future. I don't know. That would create more issues with, what he could say and what he can't say, but this is some really interesting stuff. So this is the bulk of what I wanted to cover in today's episode. This was a longer one, and it's definitely a deep dive. I'm not going to go down the whole rabbit hole. There's a lot of people who have a lot of misconceptions about how circuit breaker halts work. There's a lot of misconceptions about short interest and short volume. There's rabbit holes on Twitter and Reddit. I'm not going to go into all of those, but I hope that this at least gives you a good understanding of his thesis in 2020 and what I see as a possible thesis today, and the very fact that I don't think the 2020 thesis really truly applies today, except with the component of the transition of the business. And now they've got billions of dollars, $4 billion to make it happen. Maybe it will. Give me your questions and comments below. I hope you hit the thumbs up and subscribe to this episode. I'll see you for the next one real soon.